Welcome to Bits of Wisdom, offering insights on money, Bitcoin, and the world of exponential change. Hello, I'm Paul Rogers. Welcome back to Bits of Wisdom. This is episode 9 of our series on money, our monetary system, and Bitcoin. In this episode, we're going to get deeper into some of the key technological and software protocol elements of Bitcoin. We'll talk about the blockchain, how Bitcoins are created, why it's considered a decentralized system that's available 24/7 to everyone on Earth, and what distinguishes Bitcoin from other cryptocurrencies. So, let's get into it. The first element is the blockchain, a distributed ledger. Now, what exactly does that mean? Well, think about it. In any financial system, someone or something has to record transactions. In our traditional system, we generally use a trusted third party to record transactions. So banks keep a ledger of our account and the deposits and withdrawals we make. Every time we deposit money, they credit our account, and when we withdraw money for cash, a check, a bill pay, or an automatic debit, they debit our account. In this system, we have to trust the bank to do this properly, as they are the party that has total control over the ledger. This has advantages of simplicity and efficiency, but disadvantages also. The ledger is not transparent and is controlled by someone else. Have you ever tried to get a bank error corrected? And of course, do you really trust the banks? Now, I won't get into all of the other elements that present risk to this system now, such as the risk that assets can be frozen, seized, or compromised. But suffice it to say that you have to understand you are surrendering control to the bank. And of course, remember, as long as the bank has your money, it's not really your money. Just read the fine print. So what if there was a system to record transactions between parties that was not controlled by a single intermediary? What if there was a system that did not rely on trusting anyone? What if every transaction was recorded in an immutable fashion and it was accessible to everyone on the network? What if there was no third party that could make bank errors, vaporizing money in your account? What if there was a system that was immune from a government's ability to seize or freeze your money? For example, because of an IRS dispute or because you were on their naughty list. Now, if there was ever a straight-up guy who did things by the books, that would be me. And so far, neither I nor most of the people I know have assets frozen by the government. But that's not the way it is all over the world. This stuff does happen. Now you're probably thinking, yeah, it happens to criminals, but it can happen to anyone. During the financial crisis that swept through the world, the island nation of Cyprus found itself in deep trouble and deep in debt. So how did it respond? Overnight, it imposed a one-time tax on bank deposits of 6.75% for amounts up to 100,000 euros, or 9.9% over that. Overnight, the money just vaporized from your account, and there was nothing you could do. Now do you see the potential pitfalls of a trusted single third party controlling access to your money? And of course, remember in the US in 1933 when the government seized your gold under the threat of fines and jail? All of which brings us to the blockchain. The purpose of this system is to remove the third party and eliminate having to trust anyone with your money except you. At a high level, and there are lots of nuances, think of it this way. Every transaction with Bitcoin is recorded in an unchangeable ledger that is maintained by thousands of computers all over the world. And that's what we mean when we say it's a distributed versus a centralized ledger. There's no central party controlling it. And everyone can see all of the transactions, so it's transparent. It's a major technological breakthrough. And blockchain technology is finding application in lots of industries and situations. Now, for our purposes now, what you need to take away is that blockchain is a trustless, decentralized system, and that is a huge benefit. So transactions are recorded in a block of data that's verified and added to a block of prior transactions, forming the blockchain. This solves one of the big risks that has existed with digital assets and records of transactions. It's known as the double spend problem. So think about it. If you had a digital asset and it could be copied, like a Xerox copy, you'd be able to spend it multiple times. Remember Napster and peer-to-peer file sharing? Someone had a digital file of a song or a record, could keep the file on their computer, but also send it to others. Now that was bad for musicians, but it would be really bad if you could do that with money. Well, the Bitcoin protocols and the blockchain solve the double spend problem. Let's turn to how Bitcoins are created. Well, since Bitcoin can be likened to digital gold, it's appropriate that the term mining ended up being adopted for the creation of Bitcoin. Obviously, we're not digging into the earth to mine a digital asset. And I'm not going to get into all the details, which aren't necessary for our purposes here. But the essence is that people, now major public companies traded on stock exchanges, devote resources, energy to solve complex math problems. It's called a proof of work, to earn the right to record a block of transactions on the blockchain in exchange for being rewarded with new Bitcoin and transaction fees. Hence the creation or mining of Bitcoin. Now, there are some creative and powerful nuances in how this is done. But one feature that's built into the protocol, that's a key feature of why Bitcoin is scarce and thus satisfies a feature of sound money, is that the software and the protocol halves the reward to a miner approximately every 4 years. Now, in the early days when Bitcoin was just starting out, the reward was very high. As that has been halved and halved and halved, the reward is much lower number of Bitcoins. And as it happens, the value was of course lower when Bitcoin has started out, and now the reward in the value of Bitcoins is higher. Although the two are not linked. It just happens. That is, the reward has gone down, the value has gone up. Also, built into the software protocol that everyone in the Bitcoin system is part of is the absolute and hard and fast limit on the total number of Bitcoin that can ever be created. And that is programmed and engineered scarcity. This is one, if not the most important hallmarks of sound hard money, as opposed to fiat currency, where a central bank can create as much of it as it wants. And that's no secret. In 2013, Ben Bernanke, in testimony before Congress, was asked, where does the Fed get the money to buy assets? Do you create the reserves? Bernanke responded with a simple yes. And of course, we saw in a prior episode, Jay Powell, our current chair of the Federal Reserve, being very explicit about it. As we discussed in prior episodes, there is no limit to the amount of money that the Fed can create. The number of Bitcoins, however, is limited to 21 million, most of which, about 19 million, have already been created. Let's talk about another key feature that is really driving adoption. It is this decentralized system that is accessible to everyone on the planet and available 24/7. So, have you ever tried to move money from your bank account on a Saturday night? You can't do it because a traditional bank has banker's hours, not to mention bank holidays. Now remember, you might think it's your money, but it really isn't. They have control over it. Just read the fine print. Have you ever tried to send money to another country? It's a pain. It takes days, and it costs a lot in wire transfer fees. I mean, what are they, sending it by Morse code? Come on. This is the 21st century. They're using the same technology that lets me send an email halfway around the world in a second, and it takes days and high fees for them to move my money? Now think about it. There are people all over the world, and even in the US, who don't have easy access to a bank. Whether it's because they don't have much money, and we all know banks really only want accounts with lots of money, or because there just isn't the infrastructure around, like in much of the developing world. What if your bank was an app on your phone? Not just the interface with a big bank like we use on our bank apps, but a cyberspace bank. Most of the world already either has or will have easily access to a cell phone. Bitcoin opens up banking and sound money to the entire planet. Billions of people can now come online and have an economically viable and sound, safe way to store money. Look at what's going on in Venezuela, Turkey, or some African countries. Inflation is raging, governments are controlling and creating problems, and the people want a new system independent of their local vaporizing currency. And if the proverbial stuff hits the fan and you want to get your money out, you're not going to be able to transport your gold on an airplane. And remember, bank accounts can be frozen. I mean, even in the U.S. right now, transactions over $10,000 are reported to the government. Now, you don't have to get their approval, just the banks. But if you want to send an international wire transfer, it's going to take some scrutiny. I know. I worked for a major brokerage firm, and there were many hoops to go through to do this, and it took days. So you may not see yourself in this situation, and hopefully we will never find ourselves in this situation in the U.S. But I hope you can see the appeal that billions of people all over the world see in a system with these benefits and without the restrictions of the current system. And perhaps you're going to see it in this system too. So as the old saying goes, if you build a better mousetrap, the world will beat a path to your door. Can you see now how Bitcoin just may be a better system than our current fiat monetary and banking system, and why the world is beating a path to Bitcoin? Now, let's turn to distinguishing Bitcoin from other cryptocurrencies. And again, I'm going to do this at a high level, but it's important to distinguish between them. Cryptocurrency is a broad category that applies to a variety of digital assets. But just as there's a big difference between a stock like Procter & Gamble or Amazon and a penny stock, there's a big difference between Bitcoin and other cryptocurrencies. And in fact, it's really much deeper than that. Bitcoin as digital gold is considered to be digital property. In fact, the Internal Revenue Service in the U.S. has ruled that Bitcoin will be treated as property. So ownership of Bitcoin is ownership of digital property. This is different than something that is considered to be a security, like a stock. And while the regulatory framework is still unfolding, and that's often cited as a concern, it's catching up to these new assets. I mean, after all, our securities laws date from 1934 to 1940, so they don't quite fit. Now, the regulatory framework, though, is coming into greater clarity. And what's clear from both investors and regulators is that Bitcoin is different from other cryptocurrencies. So let's take a deeper look. Now, we've already talked about Bitcoin as digital gold, digital property. Now, what are these other cryptocurrencies? So I'm going to divide them into two other broad categories. One are sort of like technology-based systems, competing to be the best technology for various purposes. In this category are things like Ethereum and Solana and others. They're in essence technology platforms built using the blockchain technology and protocols, but they differ from Bitcoin in that they often have a centralized versus a decentralized component. These other systems were generally developed by someone or some group of people and are managed or controlled by the smaller group that can alter it to further the goals of the technology. For example, Ethereum was in part developed to offer faster and more voluminous recording of transactions to a blockchain. Don't get confused that there's only one central blockchain. Each system has its own, just like every bank has its own ledger of accounts. The Bitcoin blockchain has certain very intentional limitations built into the system, which are key features and attributes of the core system. Though now other systems are being built, such as the Lightning Network, which is called a layer 2, on top of or alongside the Bitcoin blockchain to enhance certain features. But because of these limitations, Ethereum was created so that developers in a wide range of industries and usage, from gaming to insurance, could use blockchain technology in their businesses or applications. So developers build these systems using the Ethereum framework. Now, other companies have risen up offering systems and processes of trying to improve upon the system to make transactions faster or, for example, lower cost. So you should think of these as technology platforms. And like in the early days of the internet, there were many companies that offered web browsers, for example. Remember Netscape and Alta Vista? These were technologies to use and search the internet. Now, as we all know, one company essentially won out, Google. How this is going to evolve in this new digital space, only time will tell. But buying tokens or coins and investing in these systems is more akin to investing in competing technology stocks, not like saving in digital gold. They could be great investments, they might not be. And then there are the altcoins, or as they're known to Bitcoiners, shitcoins. Hey, it's not my term, it's just what everyone, except the people pushing them, refer to them as. These are the meme coins. The most famous ones, of course, have pictures of dogs on them, and they're usually offered at fractions of pennies and by the millions to people in the hopes that at least the creators will get rich. Whether the purchasers do, well, that's another story. Now, the fact is, many have. Most famously is Dogecoin, that was actually created as a joke until it caught on so widely, generated so much money in the system with so many users, that a use case for it came afterwards. Now, most of these look more like a security. However, they're usually not adhering to the securities laws, and some of them can be more akin to that Ponzi scheme that Bitcoin is accused of being. While people can make money trading these, and people, usually the creators and the early folks, have become rich, to lump these in with Bitcoin is a huge mistake. So here we have it. We can broadly classify cryptocurrencies into three categories: Bitcoin, digital property; technology companies offering tokens or coins as the medium of usage, and a number of these will likely emerge over time to be the primary players and have a huge economic and societal benefits. And then there are the highly speculative shitcoins that are high risk, potentially high reward, but uncertain whether the point is just making the creators rich or whether there really will be a viable economic use case for them. So I hope this has helped your understanding of the differences between cryptocurrencies and why when we talk about a solution to the problems of our current monetary system, we generally talk of Bitcoin and not these others. Now, not that I personally wouldn't own or don't own any of them, it's just for very different reasons and in very different proportions. In the next episode, we're going to cover some details about buying, holding, and managing Bitcoin. So again, I'm Paul Rogers. We've got one more episode to go. I thank you for joining me for this series. If you've enjoyed it, hit the like button, and we'll see you in the next and last episode.